right now the Fed is tightening. In theory, and I guess maybe you have to compare it to what the other central banks, how much they're tightening, but in theory, that actually does add to the strength of the US dollar versus other currencies, correct?
Correct. Yes. If you think about, if people aren't familiar with, relative currency levels and relative exchange rates and relative interest rate levels, just think of it as if you were shopping for a bank. Let's say you move to a new city and there's 5 banks and you have to pick a new bank, and you go around and one bank has a history of going bankrupt and they don't pay you any interest. There's another bank that pays you a little bit of interest, but the liquidity is not very good. And then you go to a third bank, which, they've never gone bankrupt. They have great liquidity. Everybody in the town uses them and they pay you a higher interest rate. You're probably going to go with that third bank. It just makes the most sense. And that's kind of how you can visualize the US. The US is raising rates more aggressively than the rest of the world. Now, there are some other places that are raising rates as well. We're not the only ones. But relative to Japan, relative to the major economies, China, Japan, and Europe, we are raising rates much more aggressively. And that is why you've seen the dollar appreciate, because just like you moving to that new city, picking that new bank and putting your money into that bank, as we have raised interest rates more aggressively than Europe, Japan, and China, investors and asset allocators have said, I'm going to put my money in the Bank of the United States, which is the dollar. And so, it is getting the capital flows, and that's why the dollar has outperformed those other major currencies, or it's one of the reasons why that has happened.
How long do you think the Fed is going to hike? Do you think it'll surprise people and stay more committed, or do you agree that its events are going to have to force it to reverse course sooner versus later?
Well, I think short answer is I don't know. And anybody that comes on here and tells you that they know, you should probably just stop watching and run the other way, because those are scary people. Nobody knows. We're all speculating here, right? But I do agree that the Fed is going to continue to hike until they cannot hike anymore. And I tend to think that they're going to be able to do it longer than most people think they're going to be able to. Now, is it possible that they have to reverse pivot in the next month? Yeah, it's absolutely possible. But if since the Fed meeting, here's the interesting thing is when Powell came out last week, there's in my mind, there's no question his tone was less aggressive. He definitely came across as not being as aggressively hawkish as he had, in prior meetings this year. But if you listen to what he said, I don't think his words were that much less aggressive. I think he still said data dependent. We are still planning to raise rates. And he did make the comment that he thought that we were closer to neutral. In other words, getting the Fed funds rate near the inflation rate. We were closer to neutral than we were at the beginning of the year. And so, and the Fed took that, or the market took that as an indication that, he was going to slow down with his hikes.
Right. I'm sorry to chuckle, but just to parse that for a second, that's a true statement. But, it's like saying, I've taken a step towards up the mountain. Right. Doesn't mean I'm close to the top yet, right?
Right. Well, okay. So you're kind of helping make my next point, and that is that the market took that as extremely dovish, though, because now he's going to slow down hikes. Well, if we haven't taken very many steps towards the mountain, why do you think he's going to suddenly slow down? Did you see what I'm saying? So if you think inflation is going to stay high, then you have to expect him to continue to hike. But with the market took it as extremely dovish, and since then, long rates have fallen. So the long market, bond market, is saying no, he's they don't believe him. But equities took off and moved higher. Oil took off and moved higher. Bitcoin is much higher than it was a month ago. So you've got these risk assets going higher, and if risk assets are higher, it has a higher probability that inflation prints continue to come in higher. And so the market rally is kind of defeating the reason that he would slow down due to data dependency. My point is this: is they are not going to slow down when equities are rallying, the VIX is falling, and long rates are going down. They're going to pivot when equities are falling, VIX is through the roof, and the dollar funding market sees up, right? And so it kind of becomes this game of chicken, to be honest.
Well, so I just interviewed Thomas Thornton yesterday, who's a multi-decade hedge fund portfolio manager and analyst, and he basically echoed that pretty much that same sentiment. The other piece of the puzzle he added to it is he just said, look, the Fed's not going to pivot while the market's moving up. It's certainly while it's above 4,000, and while unemployment is still as low as it is. Right. So I think to your list there, I would add unemployment as well.
Sure.
So I think that is a good counter argument that's emerging right now, in response to people who are saying, "Oh, I can smell the Fed pivot. It's almost here," right? Where it's sort of like conditions are too rosy right now. And the Fed knows. I don't want to put words in your mouth. It knows that it needs more air cover to have more room to act when the next really big true crisis gets here. So it wants to bring rates higher. It wants to take some of the excess out of the system, and we'll do it as long as the thing isn't going into cardiac arrest. And it just seems like the patient's nowhere near that right now.
Right. And I think, and this is where the other part of kind of the whole dollar milkshake theory, I think, comes into play a little bit, is that as the rest of the world sees the US as a better store of value or a better place to allocate assets on a relative basis, and they send their money here, that will push up US asset prices, which in my mind makes it harder for Powell to pivot, right? And so if you think about what's going on in Japan right now, well, they're just destroying the currency, right? So do you want to be invested in Japan, or do you want to, go invest in the US where you get 2% more just to sit in cash? So capital flows to the US. What's going on in Europe right now? Well, not only is there a war on Europe's doorstep, there's an energy crisis on Europe's doorstep, and the ECB just raised rates for the first time in 10 years. They raised rates 50 basis points to get to zero. And at the same time, they announced an additional bond buying program to keep rates low. So where do you want to put your money? And if you put your money in the US, again, it pushes asset prices up, and it makes it harder for Powell to pivot, which keeps interest rates higher on a relative basis. And it kind of becomes a self-perpetuating system. And this is why I say that this has the potential to become a real crisis, because once it gets going, it's really hard to turn. It's like a battleship. Once it gets going, it's really hard to turn, and it kind of becomes self-perpetuating.
Well, all right. So could you in some ways say that the dollar milkshake is like the Fed's best friend right now, which is it's propping up the system that's going to let the Fed, basically do what it needs to do without cratering the capital markets?
Yeah. And that's, again, this is for the people who say the Fed cannot raise rates without bankrupting the country. We can't afford to cover the interest expense. I don't necessarily disagree with that, and I completely understand the point they're making. But what you have to understand is neither can Japan, neither can Europe, neither can any of these other countries, right? And so again, it's if you just want to live in theory and write research papers and work at a think tank, then this is all fantastic. But if you're actually allocating money and living in the real world, you need to understand that it's a relative world, and money has to go somewhere. It's, big institutions and big asset allocators cannot just sit in cash. They don't have that option. So they're going to put their money somewhere, and they're going to put it in the place that is best on a relative basis. And so I think that has dramatic impacts on the rest of the world. And like I said, I think we're already seeing them this year.
If you enjoyed this video clip, click here to watch another one you should like.